Morning, happy Friday, and welcome to Sunrise Small Talk episode number 63. Sticking with the theme of April taxes, April will be Tax Awareness Month, and I'm about to step inside the Windsong Event Center and present to a group about some tax strategies, but we obviously had some pretty crazy volatility in the market this week, so I want to address that. Talk a little bit about tariffs. We'll talk about what it means, some pros and cons, and then your portfolio. What do we do? So here we go. Let's dive in. All right, what I think we need to address first is just what were the tariffs, and maybe talk about some of the why they were so drastic and how drastic they really were. So number one, if you look at the different analysts, we have Goldman Sachs on the low end. They look at that as about an 18% average tariff across the board, and then on the high end was about 30%. I don't remember which analyst that was, but 18 to 30% is kind of where we stand. The why, I mean, who knows? I don't really know why. I know Trump has been recorded as back as early as the 80s saying that we need more tariffs. I'm not going to try to get inside his head and really understand what's going on. I don't love it because it's definitely affecting the market, and I'm sure nobody really enjoys seeing their account balances drop. But overall, kind of the way that I see it is the tariffs were across the board, right? So I think we all know is a 10% minimum and then half of whatever the country's current tariff is on the United States. So I think what he was trying to accomplish here is just set something across the board so we could get it in place and move forward. And then that puts a lot of pressure on the other countries' economies. And my assumption would be that now they will come to the negotiation table and maybe we can have some resolutions. And that would obviously really be the point where we could see some turnaround in the market. Another important point to note is if we're looking at a country that, say, has a 50% tariff on the United States and our reciprocal tariff is 25%, well, that's just completely inaccurate because those calculations are actually based on the trade deficit that we have with that particular country and have nothing to do with the actual tariff. So in that scenario, maybe it looks like a 50% tariff because of the trade deficit, because we send them more goods than they send us. Sorry, I have that backwards. They send us more goods than we send them. So there's a calculation there, and you can probably find it online. I'm not going to go into it because it kind of is challenging to understand. But really, the reciprocal tariff is not based on a tariff on the United States. It is based on a deficit. So that's important to note, I think. Pros and cons, just the market in general. I think some of the biggest pros I look at is we look at something in our industry called the put to call ratio, and that just can be a signal of are we going to have a reversal? Are we going to have a turnaround? When we bounced off the 10% drop a couple weeks ago, I guess it was, we didn't quite see that put to call ratio where it would dictate or possibly hint at the fact that this is going to be a permanent reversal, whereas now we are maybe seeing that where the put to call ratio could possibly be telling us that it's a more permanent reversal if we do have a reversal at this point. And overall, the economy is strong. So we had the job claims report come out, and that came in lower than expected. And I think two of the biggest concerns, just on being on calls with the Carson Investment Research Committee, folks who are way smarter than I am, PhDs, CFAs, a lot of really smart folks over there. There's a reason I picked them to manage the portfolios and the assets. I think they're incredible. But they're looking at, number one, credit markets. And what I mean by credit markets is bonds. Credits, that's bonds. The bond market, the credit market is still strong. Could that change? Sure. Jobs. We have not seen an increase really in jobless claims. So that number, again, actually came in lower than expected when it was reported this past week. So those are two really critical bullet points to determine whether or not a recession is likely, and we're watching those closely. But as of now, those have not flipped into a concerning territory. So that just kind of goes along with the theme that we just don't see a recession right now. Are there cracks? Yes. Are things starting to maybe look a little more negative? Could we change our call on that? Yeah, possibly so. But at this point, the call is no recession until we see some major weakness in credit markets, rising job claims. Then kind of that'll probably won't change the expectation and the outlook on that. Overall, what do we do about your portfolio? I think number one, the biggest thing is just looking at your bucketing strategy. If you log into your portal, you're going to see you have bucket 1, 2, and 3, and the assets in bucket 1 are assets that are intended to keep your money safe anywhere from today into the next 3 years. So when we have major drops in the market, bucket 1 just really isn't going to be affected, and if it is, it's going to be pretty minimal. So it's important just for us, that's kind of a psychological thing that we do, is we know that, okay, as long as things come back in the next couple of years, really this downturn won't affect us. So that's important to keep that perspective when you log into your portal. Number two, I talked a little bit about this. I believe it was episode 61 or 62, and let me know. I can send it to you if you want to see the diagram I drew. But we have not me, I'm not smart enough to do this, but the investment committee has basically designed something within the portfolios where we take the S&P 500 index, and as opposed to just buying that index directly, sort of create our own index by putting two components together. That's going to be low volatility and momentum, and basically what you're doing is you're creating your own S&P 500 index, but it tends to be more efficient and better performing index. And if we look at those numbers year to date, we are, see, I've got a note here. If we look at the S&P 500 index year to date, as of the time I recorded this, could change, minus 2.6%, whereas you look at our combination of low volatility mixed with momentum, and it's actually positive 0.5%. So you're getting the same risk, the same type of an index, but just if you chop up this year and looking into last year, it's actually outperformed its index of the S&P 500. Diversifying the diversifiers. So what I mean by that is obviously a diversified portfolio is really important, but diversifying those diversifiers even further, and some things we're looking at there in the portfolio is actually March 31st of 2023, Carson added its first little piece of gold to some of the portfolios. And we still have that gold. So gold is up it's up like 50% or something over the last year. You might have to fact check me and look that up, but it's up significantly over the last year. Another thing we're really happy about is the managed futures that we put into the portfolio. That's been kind of a shining star in the midst of all of this turmoil. And as I say all this, I also have to tell you that this is just kind of general, looking at Carson's internal models, our house view models, our tactical models. I honestly think all of you own both of those models to some extent, but have to give the disclosure that I'm just speaking generally here. The best source of information is to look at your own statements, and everything I'm talking about is just looking at averages kind of across the board, not specific to your actual performance and investments. So throw that disclosure in there. Let's see what else. I think that's kind of everything I wanted to cover. But overall, I think it's, stay invested, unless you've had a major shift in your risk tolerance, your appetite for risk. There's no reason to make any changes at this point, in my opinion. I know what you're thinking, Andrew. You're just like this permanent bull. You always say the market's going to go up, and the reality is, yes, I have said that. Some of you have worked with me since 2005, 6, 7, 8, and 9 when we had that market, and I was not a bull back then. There was a point back in 2008, 2009 where I said this market is horrible and scary, let's get out of it. And since we rebounded in 2009, I think I have been a bull ever since then. And I just believe in our markets, regardless of temporary turmoil and fear and panic and everything that's going on out there. Even the best years have pullbacks. So just because we're in the midst of this right now doesn't mean that come December 31st, we maybe are looking pretty good and having some nice gains in our portfolios. So there you go. Have a great weekend, and we'll talk to you soon. Bye.